Saw that article. It said almost 80% said gold will be a higher share of reserves 5 years from now, all the central banks. And, to me, this isn't gold hype from the World Gold Council. This is the fact that the world is hedging against the dollar system. And I think that is what is happening. When you look at you look at the amount, there was an interesting article I read that talked about energy and infrastructure, where China every year is building onto their energy infrastructure more so than our entire grid, which is 50, 60, 70 years old, whatever, that is in a state of disrepair. The amount of energy you needed to build electricity and to build it that will work for AI and the needs of a globalized, or of a country that is digital, that is using AI, that is looking at a system that is broken and in disrepair. If we want to reshore manufacturing, if we want to be competitive, we need to start also by fixing the power supply and upgrading it. There is no way of doing that, but where's the money come from? Right? So we're already broken, insolvent. So we're going to print more money. Again, all of the things we're looking at going forward speak to the decline of the value of the US dollar. That's the bottom line as far as I'm concerned. The US dollar is in very, very big trouble ultimately, because we don't have enough money to do things like build out the grid, to build out our infrastructure, when China is doing that nonstop with their trade surplus, and we're not. And China has the energy advantage and more power and a newer grid, and we don't. And I think we're losing. We're in a competition that we can't afford to lose by rebuilding the grid, reshoring industry, keeping up with the AI tech costs, involved with all this, cost trillions. And where's it going to come from? It's going to come from abandoning the reserve status, as we've talked about, as I've screamed. Now, I might be the only one saying this over and over and over again, that I really believe that we are going to softly default on the reserve status in order to reshore things. And I've gone into that thesis enough. I don't need to go into it again. But I think the bottom line with all of this stuff is stop looking at the noise, at the daily moves. Look at the big picture. The big picture is that the dollar is going to be what is going to be sacrificed in order to compete with the rest of the world, whether it be to reshore, whether it be to rebuild the grid, whether it be to keep up with AI, whether it be to bring back manufacturing. And so gold and silver will be the benefactor of this. And when you see the amount of huge money over the last 8, 16, 17 months that has stood for delivery, that's all you need to see. They're positioning, and they're continuing to do so. And if it's that important for the governments to do so, they won't make it easy for the rest of us. The volatility, the counterintuitive rhetoric, all of this stuff, that's all part of what they've done forever. And as the stakes get higher, so too will the volatility. And the ability for those to hang on will be less and less and less. Don't let go. Don't sell your metal. That's all I can tell you, is that this is not over, not even close. This is the volatility one would expect in a shift like this. And big money, big stakes, big volatility. You talk about the Bloomberg headline that ran cover for the paper smash, as far as I'm concerned, where they said Russia was going to jump back on the dollar standard. And this precipitated forced index selling, and along with the margin hikes and the dumps by the algos, or the algorithms that run everything. And when they start to see selling begets sellings. And in a fraction of a second, you saw $3.5 trillion erased. And then quietly, the report comes out that says Russia is on record saying they're not going back to the dollar standard. Yet that day, Bloomberg pumps the opposite narrative, and that's the news. That's the positioning news that we get. It's almost like they're running cover for it. But when you talk about what's happening right now in the silver market, look, we're 10 days away from the first notice day of delivery for the March silver contract. And I think people really need to understand what this means. As of Friday, there was 58,770 contracts that were left open interest, as it's called, that could stand for delivery. Each contract is 5,000 ounces. So that's 294 million ounces open interest right now for the March contract. A bunch of it has rolled to May, to the May contract, because there was about 400 million ounces a week ago. So about 100 million ounces have rolled to May, which is the next big delivery month, not April, it's May. And that's normal, right? But it's still really very huge that we have 300 million ounces open this close to first notice. So I think what I take away from that is not a COMEX default, but even half of the open interest actually decided to stand for delivery. You're talking 150 million ounces that would need to get sourced, right? The problem with that is that the registered silver category, that is the available silver backing the contracts, available to deliver, is about 90 million ounces, right? So, do the math. If demand for delivery spikes, COMEX has two options: either drain registered inventory very fast, which would be, I guess, a very serious drawdown, or you have the price of immediacy increases, where you have forced incentives. Premiums will increase, exchange for physicals will increase. They will try and get people to roll to May by incentivizing cash settlements with a premium, anything to keep anything to keep metal from leaving. And in my opinion, this is how the stress shows up. It's not in price, but it's in the delivery mechanisms and the delivery mechanics. And when the paper claims tower over the deliverable silver, I think the market is calm until it isn't. And so I think really what you're looking at is even a portion of this stands for delivery. 20% stands for delivery. You're talking, 60 million ounces of the 90 million. This is a problem. And so I think that's, to me, the biggest issue right now. What I'm watching is we'll see what happens over the next 10 days. At the same time, you still have this big $10 premium in Shanghai over the Western price. That this arbitrage is not going away. They're continuing to incentivize the people here in the West who have the ability to buy cheap, $75 or whatever, and sell it for $85 in China. A lot of people say, well, what about the difference in price is the tax. The VAT tax, right? Not tariffs, that there's a VAT tax, which is true, but it's not true, right? These are people who are not quite understanding the mechanics. The VAT tax is really there, but it's the responsibility of the recipient, because when metal is delivered to Shanghai and you get that $10 arbitrage spread, you deliver 50 million ounces at $10, you just made $500 million. That VAT tax is the responsibility of the recipient when it leaves the Shanghai exchange. So it's not paid until it leaves. If it stays there, there is no tax. So in other words, that arbitrage is significant enough at this point for a $10 premium plus like a 13 or 14 or 15% tax. They don't care. They want the metal. And so this is all, I think, noise. You have to see the big picture. You have to relax, see the big picture, understand it for what it truly is. And I think, yes, the volatility is enough to freak a lot of people out. But look, silver is the canary in the coal mine. And I think it's exposing a paper market built by banks that trade credit, not real metal. And real demand is showing up in Shanghai, and price discovery is shifting there. It's leaving London, it's leaving New York, and as long as the Western paper market stays disconnected to Shanghai like it is now, the physical silver will keep getting pulled out of the West and sent to where it's valued. And look, the scary part, it's even getting tight in Shanghai with premiums starting to blow out. And I think that's why, to me, the forwards and the futures are starting to feel almost undeliverable for a lot of people. This is why you're seeing backwardation. where the market makers are having a hard time sourcing metal. They can't hedge easily. Their exit becomes the move, maybe, right? And getting out. And I think that's what you see every time they smash the hell out of it. Are they doing it to get out along with stand for delivery? Are they doing it to extricate themselves from these stupid short positions that used to work before this was all, I think, figured out?